This is Matthew Cratter from Trader University, and today I want to talk about why stocks have been crashing. We had a really big down move this last week, especially in a lot of the momentum names, and so wanted to talk a little bit about the context behind that. It really all comes down to this guy. We're currently living in an extreme version of clown world, where central bankers rule everything, and what matters more than the real economy is what they say when they give various testimony. The real question is Jerome Powell going to be able to keep the money printers going? That's a much bigger question than anything else in the economy. Things get really weird once the government debt levels get as large as they are. They're currently above 120%. They peaked at 135% of GDP. And what this means is that government debt is currently larger than the actual economy. And when this happens, you get the debt tail beginning to wag the dog. And what really matters is central bank policy matters much less than the real economy. Now, no economy that's ever gone beyond 130% debt to GDP levels has ever come back. Japan has been well above that for a while. They are kind of a strange case. They've been surviving, though not exactly flourishing, for the past 20 years. But every other case, things have gotten really bad for the country. Now, what we've been watching is yields, interest rates move up. This is the benchmark yield on the 10-year note Treasury, which is really the main rate that everyone looks at. And it's really moved up almost 100 basis points, or a full percentage point, since last year. Now, the reason this matters is because when you have as much debt as we do now, close to 27 trillion in debt, a 1% move up, or 100 basis point move up, has a big effect on the debt payments, the interest payments that the government has to make. This happens over a slow period of time, and there are various adjustments because the government doesn't borrow strictly at the 10-year level. It'll borrow at a lot of T-bills at 3 or 6 or 9 months, etc., all the way out to 30-year treasuries. But one way of thinking about it, if we have approximately $27 trillion worth of debt, every 1% move up in the interest rate is $270 billion. Current interest on the debt is $395 billion. So you get a very big move in this line item. The biggest budget items are obviously the entitlement spending, Medicare, Medicaid, Social Security, the war defense budget, and then fourth is interest on the debt. And when interest rates move up, this increases the debt burden on state governments as well as the federal government. And this is one reason that the tail ends up wagging the dog. In addition, because the economy itself is so levered, consumers, corporations, and the government itself, that when interest rates move up, it hurts the entire economy. Here we can see that mortgage rates have moved up quite a bit over the past, really since the beginning of the year. And this has led to a decrease in mortgage applications for new purchases. And so this is why these interest rates matter so much. And these interest rates are really increasingly set not by a free market, but by central banker policy. If you're enjoying this video so far, I'd encourage you to hit that subscribe and like button. So what happened last week? Well, we had Powell testify in front of Congress, and the more he testified, the less the market liked it and began to sell off. The problem, what people were looking for that Powell didn't really mention or address in a really explicit way as people wanted, he didn't discuss yield curve control, YCC, which basically means buying a lot of treasuries at a certain point on the curve in order to keep interest rates down. Now, this can be a very dangerous game to start because if interest rates want to rise, you might have to put a lot of money into the bond market to keep interest rates low. Basically, interest rates move the opposite direction from bond prices or treasury prices. And so if the Fed, for example, decides to cap interest rates at 1.5% or 1.6%, this would require a lot of money printing that would then be used to buy treasuries. But this is what the market wants to see. It wants to see a cap on rates, It also wants to see an extension of what's called the SLR. We haven't talked about this too much, but it is somewhat important. This is the Supplementary Leverage Ratio. And this was an emergency program that was put into place last year in the first half of the year when the Federal Reserve decided to exclude holdings of treasuries by banks from the calculation of their leverage ratios. Now, this is a program that it's a temporary exclusion that expires on March 31st of this year, and it's almost certainly going to have to be extended. But people, market participants and Fed watchers, were not happy that Powell did not come out and say that it's going to be extended. And so we have this weird game of chicken where the market is testing the Fed's resolve. And when the Fed doesn't do what the market wants, it has a little tantrum and sells off. The reason this SLR is so important is the government is issuing so much debt now. We're only collecting $3.5 trillion in taxes, and federal spending is close to $8 trillion. So that difference has to be made up with borrowing. It's about $4.5 trillion right now, and you need a place to put this debt. Foreign investors are less interested in buying it at this point, and the buyer of last resort is the Fed. But before that, they've been trying to stuff the commercial banks as full as possible with these treasuries. These are very low-yielding treasuries, obviously. No one wants to make 1.5% on their investment as a yield when inflation is much higher than that. And so you really have to stuff it into insurance companies, into pensions and endowments through regulation, as well as into the banks. And that's one reason that the SLR is so important and why it will almost certainly be extended. We can expect to see a rally in treasuries and a rally in other assets like stocks when this exclusion is extended. But the market didn't get this from Powell last week, and so was a little bit upset. Here are the treasury holdings by commercial banks, and we can see how much they've moved up. Really, from February of last year, they're at about $3 trillion. They're currently closer to $4 trillion. So this is a really important place that this junk paper gets stuck, and the market needs to see this. This is a very strange collusion that's happening between the federal government and the banking system, where these treasuries are being stuffed into the banking system. So the real problem is, another way of saying that interest rates have been spiking, is that the Fed has not been buying enough treasuries. The government has to issue all this debt to pay its bills because it's not collecting enough in taxes. The real problem, it's a spending problem, it's an entitlement spending problem. You could confiscate 100% of the wealth of all the billionaires in the U.S., and it would only last you for about half a year or so. So this is really a structural problem. You could increase taxes to 100% on everyone, and it still would not solve this problem. Now, we know the Fed's not been buying enough treasuries, simply because we see asset prices weakening. We see spiking interest rates, spiking yields. We've also, in the last week, I haven't really talked about this, but we've begun to see a lot more disorder in the treasury market and the repo market. Bid-offer spreads on long maturity treasuries, the 30-year, have been moving out. They're at the highest spread level that since really the crisis in March 2020, the liquidity crisis. And so this is very worrisome. This is supposed to be the most deep and liquid market in the world. This is, quote unquote, the safest assets to hold, even though they don't really preserve their purchasing power. But this is what the whole world holds as a reserve asset. The world holds treasuries. And as we said, the yield is really a benchmark for pricing risk. And so if you have liquidity problems in this giant market, it is a sign of basically the government issuing too much debt. And this was one reason the Fed stepped in the third and fourth quarter of 2019. There were stresses in the repo market, as well as the liquidity crisis of March 2020. And we're now at the point, with the tail wagging the dog, that the Fed is going to need to stay involved in the treasury market really for the rest of our lives. If they don't, you get widening bid-ask spreads, you get decreased liquidity, you also get falling asset prices and a spiking US dollar. So this is what needs, basically the US has this addiction. It's like a heroin addiction. The markets need the Fed to keep printing money, to keep interest rates low, and to keep mopping up all this Treasury debt. And there's really no way a heroin addict can go cold turkey, go through various treatment programs. But the only way for the US government to go cold turkey is to stop issuing debt, to massively cut spending, which would be very deflationary. You wouldn't be able to pay all the retirees their Social Security and Medicare, Medicaid. And this would be a huge problem. You also wouldn't be able to afford the defense program. This is how the U.S. functions. This is proof of work. Bitcoin is proof of work, where it expends energy to secure the system. The U.S. government does proof of work by bombing a country whenever there's a new president. Trump, a few months into his new term, bombed the Middle East, and now Biden has done it too. So you can't really cut defense spending when you have the world reserve currency. You have to keep the trade channels open, etc. And so there's really no way for this heroin addiction to be reversed. The government's going to have to keep issuing new debt, and the Fed's going to have to keep printing new money and buying it. And so we have a situation where the markets, especially the stock market and the bond market, the Treasury market, are going to trust the Fed's. They're going to test the Fed's resolve. And if the Fed doesn't do what they'd like, the market will start to crash. This will panic the Fed, and then they'll come right back in and start money printing again. Something similar happened, I believe it was 2012, 2013. It was called it was called the taper tantrum, when the Fed tried to taper its quantitative easing, its money printing and bond buying, and the stock market didn't like it, and the Fed needed to step right back in. Something similar happened in 2018 as well, where we got a mini stock market crash when the Fed tried to shrink its balance sheet. So this is what we're in the midst of. It looks to me like Treasury yields on the 10-year note may have peaked. They've been very volatile, but we've been getting these long wicks as the market higher yields are met by buyers who come in and drive the yields back down. So as soon as we see this stabilize and stop hitting new highs, that will definitely be constructive for the stock market and all other asset prices. What we may be seeing is a little bit of an echo of what happened in March of 2000. I don't think we're going to have a crash as we did back then, but we had something similar where there were a lot of IPOs in late 1999, and then the 6-month IPO unlocks expired, obviously 6 months later, and there was a lot of selling coming into the market. We've been seeing that with a lot of IPOs that came out 6 months ago. They've had their unlocks, and the stocks have really taken quite a hit. There's also been a lot of tax selling. My sense is that a lot of the Wall Street bets and Robinhood traders don't really realize, or may not realize, how much they owe in taxes, and they may need to actually sell down their positions a bit to raise money for the April 15th payment deadline. This is a little bit of an echo of what happened in March 2000. The difference right now is that the U.S. government debt situation and the activism of the Federal Reserve are at a whole different level. Interest rates were at, call it 6%, 5 or 6% in March of 2000. Now they're still relatively close to zero. And the swings that they have when they're close to zero are really magnify the movements in asset prices. And so what's going to happen, it's always hard to say exactly where this market's going to bottom. We did see on Friday, we saw a massive sell-off in the first half of the day, and then the buyers came in the second half. And as a result, we see a lot of really long wicks, sort of like hammer formations in momentum names like the ARK ETF, in Tesla, which is obviously a big holding of the ARK ETF, etc., in Virgin Galactic, etc., where some of these have been testing the 200-day moving average line. Even if we look at the Nasdaq, at the QQQs, it also put in a big hammer candlestick. I could see this possibly retracing back down to the 200-day moving average line. But at a certain point, the Fed will get quite worried. A lot of the tax receipts do come from stock market gains, and so a weak stock market actually hurts the government's deficit problem. And this is what Powell is obviously quite aware of. The one asset that's really been outperforming everything for this year, we can see the NASDAQ is down more than 1.5% for the year as measured by the QQQs, this blue line. Bitcoin is still up, call it 68% since the start of the year. So we are seeing this decoupling of Bitcoin from the stock market, from momentum names. A lot of people think that Bitcoin's going to crash simply because these momentum names have been showing weakness, but it's a fundamentally different asset. And momentum stocks do benefit from Fed printing. Bitcoin is a more pure play on this, and it benefits much more. And what the Bitcoin prices are telling us is that the Fed's bluff is going to be called. They're going to have to continue their money printing. They're going to have to ramp up the money printers, which is good for Bitcoin and will also help to resuscitate the stock market in the process. But in the meantime, we're in a difficult trading environment. A lot of the momentum names I talked about on Wednesday have had big pullbacks. Make sure you're using stop losses and everything. And this isn't a bad time actually to be on the sidelines. Things are volatile. There are some systemic stresses happening, especially as we said in the repo and Treasury markets. And as a result, it's important if you are going to trade to use tight stop losses and not to get too aggressive. We may have put in a temporary top here for a while in the stock market and may see some chop until we see a very strong announcement coming from the Fed. As we said, an extension of the SLR ratio will definitely, the SLR exclusion will definitely help the stock market, as well as announcements of more Fed purchasing of treasuries. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.